Hello and welcome to everyone. Today we'll be starting the 10th week of this course on financial econometrics, and today is the first lecture of the this week where we'll be talking about volatility models. Volatility is volatility basically the measure how much an asset's price fluctuates over time is a very important concept in the financial econometrics where we use the volatility for the risk management, option pricing, or the portfolio management. The, it plays a central role. So let us just see what we mean by the volatility. See, the volatility basically measures the degree of variation or fluctuations of the price of the stocks or value of any financial assets, portfolio, or market indices over a period of time. It basically reflects the uncertainty or risk associated with that particular prices. And higher the volatility means there is the greater fluctuations in the prices, and it is also reflects there is the higher risk associated with that particular instruments. There are the different types of volatility based on how we measure. Broadly, there are the four measures we have the volatility. That is historical volatility, which is based on the price fluctuations of the past observations over a specified period. For example, we can take standard deviation of the stock returns over the last 30 days or last 1 week. So these are when the historical volatility basically is based on the past price fluctuations over a certain specified period. Another type of volatility is the implied volatility, which is basically derived from the prices of the assets options. It reflects the market expectation about the future change in the prices, unlike the historical volatility, which is based on the past price observations. Another kind of volatility we have realized volatility, which is based on the actual price movements observed over period of time. So this is the realized volatility we have. And the another volatility, what we call the conditional volatility, where we use the different econometric models to calculate the time varying volatility. And that's the basically concern of this week's lectures. So for example, we have ARCH model, GARCH model, which stands for autoregressive conditional heteroscedasticity model, and GARCH, which basically stands for the generalized autoregressive conditional heteroscedasticity model. And the question comes, why we are concerned with this? Why we need the different type of models? Whatever the models we have discussed till now, for example, autoregressive model or the moving average model or the mixture of these two processes, that is the ARMA model or ARIMA model or the multivariate time series models, why we can't use those models? Why we need a different types of econometric tools or models to concern all these? So the first thing in finance, let's say the investors are not only concerned with the expected return or the average return, they are also concerned with the risk associated with this. For example, the famous theory what we have, the mean variance portfolio theory. So these theory are not concerned or not depends only on the return, rather than also depends on the risk or volatility associated with that particular asset. So this particular fact itself requires that we need such kind of model which deals with the volatility or the variance of the series. So volatility as measured by the standard deviation or variance of the series is often used as the crude measure of the total risk of the financial assets. And the most of the financial theory wants to model or explains this the risk associated with the financial asset. Moreover, the models which have studied till now, or which are the models which we have discussed till now, is based on the assumption that the relationship among the variables is linear. However, we know that in the financial relations are inherently non-linear. There are the certain reasons, there are the certain specific process which makes it inherently non-linear. For example, information in finance is quite asymmetric. So when we have the asymmetric information, this quite often leads to the non-linear relationship or payouts of dividends. That also creates the non-linear relationship among the financial variables, or for example return variance relationship. So these are the certain features which makes the financial relations inherently non-linear in nature. However, the models which we have studied or discussed, they are assuming that the relationship is linear. Moreover, in financial series, in the financial theory, in financial data, often we see the presence of the leptokurtosis or volatility clustering or the leverage effect. So these certain features or presence of these certain statistical uh, characteristics creates a different kind of impact or have the different kind of implications, which again uh, warrants to have a different group of models. However, in conventional econometrics, which we have studied here, so often we have assumed that the variance of the disturbance terms are constant over time. However, we will see these are not constant in case of finance. So the such behavior, which is often observed in the financial data, is not will be captured by the linear models. Therefore, if we use such conventional linear models to explain or to predict or to model uh, the financial data which shows such kind of behavior, it will lead to a misspecified results. So results will not be reliable. For example, let us say if there is the leptokurtosis, then what is the leptokurtosis and what implications it has? So we know that this leptokurtosis is nothing but it is we call it a distribution is the leptokurtosis if it has a fat tails and the sharp peak compared to a normal distribution. So it indicates basically that extreme events, it could be positive or it could be negative, are more likely than predicted by a normal distribution. For example, we can observe this graph here. So this part shows a leptokurtic, whereas this red dotted line shows a normal distribution. So here we can say we can observe these are the fat tails compared to the normal distribution. Another what we can see here it will be more sharp peak compared to the normal distribution. So if we have this, that means in such cases, we will not be able to use the linear models or the previous discussed models, which assumes that the variance of the error terms is normally distributed. Then what implication it has? So once we have, so it shows that the financial return exhibit more frequent and larger deviations from the mean than a normal distribution would predict. Another implication what we have, the models assuming this normality underestimate the likelihood of the extreme losses or gains. For example, shocks. Investors faces here the greater tail risk, the risk of extreme losses, because here there is the more chances to have the extreme events. Then the risk matrix like the standard deviation or the Sharpe ratio are insufficient in capturing the true risk of leptokurtic distribution, because these statistical measures or matrix of the risk matrix assumes that the variance is normally distributed, which is not the case here. Then this diversification strategies based on this normal distribution might fail and the laptop processing increase the likelihood of the simultaneous extreme losses across the asset, then this portfolio diversification may not work. Similarly, we have the phenomenon of volatility clustering, which basically shows that the that particular phenomena where high volatility in the financial markets are followed by a high volatility, and periods of low volatility are followed by the low volatility, or we can say where there is the persistence of volatility. So in such cases, again, we will have the problem. For example, here we can observe the where is the low volatility? It is continued with the low volatility. Where we have the high volatility, we have the persistence of high volatility. So if such behavior we have, then again it has a certain implications which undermines the predictability of the linear models which we have discussed. For example, this future volatility can be forecasted using the past volatility, because here we have is the relation shows that if there is the high volatility, then the future periods will be followed by the high volatility. That means if we are using the previous volatility, we can predict about the future volatility. Then this traditional risk models, which assumes the constant volatility, underestimates the risk during the turbulent crisis period. This volatility clustering affects the pricing of options and other derivatives because their value depends on the expected future volatility, where if you are assuming the volatility is constant, then this expected future volatility will be different. Further, this volatility clustering increases the uncertainty of returns, affecting the portfolio diversification strategies here. Moreover, this volatility clustering influences investor behavior, often leading to hoarding or panic selling during the turbulent times. Therefore, we need a separate kind of treatment of such financial data. Then the observed phenomena in the financial markets, where negative shocks, a drop in asset prices, tend to increase volatility more than the positive shocks of the same magnitude, what we call the leverage effect we have. So this leverage effect again has the certain implications. So what we mean by the leverage effect, we can see here. For example, what we can see that if the higher fluctuations has been followed by higher volatility. So wherever we have high negative returns, then there is the higher volatility we have. Where is the same fluctuation, if it is positive, then the volatility is not of the same scale. So here we have the positive, but the volatility here is more of the increase negative. So this is again the leverage effect we had. Then what implications this leverage effect had? So first implication, this is the asymmetric volatility behavior we have, not the symmetric. It is not based on the positive change and negative change of the same quantum does not have the same volatility behavior. So the volatility behavior is asymmetric, and it impacts on the option pricing. Similarly, it becomes difficult to the risk management when the volatility is asymmetric, or where we can say where there is the leverage effect. So in such cases, we need the separate models. Then what is the nonlinear model? How we can capture the nonlinear behavior? The Campbell and Lowe and McKinley in 1997, he has given a general framework of the nonlinear model of the form of this, where they assume that this ut is an IID error term, and here this f is a nonlinear function. Then he further specified that definition of the nonlinear in such a way where we can see that this yt is the function of g plus ut into sigma square ut minus 1 ut minus 2, where g is the function of the past error terms only, whereas the second function is the sigma square is attached or multiplicative form. So this the function g could be nonlinear. If it is that, then we'll call the nonlinear in the mean, while those with the nonlinear sigma square we call nonlinear in the variance. A model could be nonlinear in both However, here our concern is the nonlinear in the variance. So, so Campbell-Low and McKinley has shown that a nonlinearity in the relationship also could be captured through the nonlinearity of the variance. So that's the basically will be the focus of this particular week. So this we know that a lot of nonlinear models could be transformed into the linear and we can use the linear models. However, in the finance we have discussed that the many relationship which is basically inherently a nonlinear in the nature. That in that case, transforming will not solve and we cannot use the nonlinear models. For example, we have nonlinear models, guard or deep switching models, and there are many other models we have. So these observations necessitates that we should have a different models which could describe the phenomena of the volatility rather than the mean. So that's what in the volatility models we try to do. Before that, what are the volatility models are there? Let us see, these are the theoretical perspective we have. Does this perspective or these features or characteristics is also represented by the observed stock prices or any other prices? So next we are going to discuss that, and those are known as the stylized facts. So what is the stylized facts? These are basically empirical and statistical properties of asset returns generally observed across the assets, markets, and over time. And these characteristics and these features are known as the stylized facts. So stylized facts are so consistent that they are accepted as a truth. So the Taylor has defined that the general properties that are expected to be present in any set of returns are called stylized facts. Yes, it could be that sometimes they may not represent some of the features, some of the characteristics. However, in general, overall, we observe this kind of features, statistical characteristics across the assets, across the markets, and over the period of time. So these are known as the stylized facts. To understand that, here we will take the BSC 100 indices and we'll try to find out what are the generalized features, what are the stylized facts we can observe here. So this is the basically representation of the BSC 100, how it has evolved over the years. And this is the basically transformation of that series into the return form. So this is the return of the BSC 100 indices. So what are the facts we have? So let us first look the first stylized facts. So the first stylized fact says that there will be absence of autocorrelation, and because of these characteristics we have the efficient market hypothesis. Because if there is no autocorrelation, we cannot predict using the previous about the future price, and this makes future prediction difficult. So let us see here. So this is the autocorrelation structure of the BSC 100 return. So here we can observe only at lag 1, it is 1. Apart from that, there is very minor autocorrelation functions we have. So it reflects, yes, mostly there will be absence of autocorrelation into the stock returns. Second stylized fact is that the distribution will be non-normal or there will be fat tail. And basically that is nothing but the leptocosis. And if that present, we have seen what are the implications we have. So let us see, do we have that feature here? So the unconditional distribution of asset returns are usually non-normal. So it will be fat tail, means higher probability of large fluctuations, whether it's loss or whether in terms of gains, than the normal distribution would suggest. Let us see here, we have plotted the distribution of the BSC 100, then we have superimposed the normal distribution. So what we can observe there has, we have the fat tails here, here, and here we can see this is not following a normal distribution. So another measure for the presence of fat tail is the kurtosis. Here we can say kurtosis 17.09, which again enforces that yes, this distribution is not distribution of the BSC 100 is not normal. It has fat tail and it has the kurtosis. QQ plot is another measure to examine the distribution of the uh, any asset prices or any asset series. So if our sample was drawn from a normal distribution, then a straight line will be followed. The existence of factors may be indicated by the deviations from the straight line. So let us plot the QQ plot of our BSC 100. So here we can see there is the fluctuation, there is the deviation of the QQ plot from this straight line, again reinforcing that the distribution is not normal. Then the third stylized fact is that loss gain asymmetry. That is, the quantum of loss and quantum of gain will not be symmetric. So return show large drops, but not equally large upward movements. So the loss is often larger than the gains which we observe over the period of time. So consequently, the return distribution is asymmetric or negatively skewed, which we have already observed into the distribution of this series. The fourth stylized fact we have the aggregational Gaussianity or the normality. What we mean by that? As the time scale between the two observations is increased, over which returns are calculated, their distribution becomes more and more Gaussian. To understand this, let us observe this here, the distribution with the different vectors. So, so what we mean by the lag returns, if we are calculating, let us say, right, R1 here is YT minus YT minus 1. So that here the lag is only one period. You may calculate R2 here, YT minus YT minus 2. So then here the lag period is 2. That's what we mean by the scale of the lag calculation. So here we can see as the lag increases, here we have lag 1, then lag 2 and so on. So we can observe here as the lag increases to calculate the return, it moves to us to the normal distribution. So that's the stylized fact which we observe across the assets, across the market and over the period of time. Then the next stylized fact what we have, that is the leverage effects. So most measures of volatility of an asset are negatively correlated with the returns of that particular asset. So higher the negative return, more the volatility. Lower the negative return, the lesser the volatility. That is the negative fluctuation creates more volatility compared to the positive inflation. And in generally, if we observe, that's the basically behavior we have as a human being. We often we remember the bad experience along for the longer time period, whereas the a good moment we often forget, and that's moreover the bad experience has a more impact on us, whereas the good experience has very little impact on us. So that's all how this asset prices also behaves. If there is the negative return, there will be higher fluctuations. If there is the positive return, there will be the lower fluctuations, what we call the leverage effect. So this leads to adopt, basically this will warrant us to adopt autoregressive conditional heterostochasticity or generalized autoregressive conditional heterostochasticity models. This happens because high volatility usually means a market in panic, where the prices go down. So another stylized fact what we have, the volatility clustering. So what is the volatility clustering? Basically this volatility display a positive autocorrelation over the several days. So which quantifies the fact that high volatility events tend to cluster in time. That means there will be volatility persistent. High volatility will followed by the high volatility. Again, it will followed by the high volatility. So that's what we call the volatility clustering. Uh, to measure the volatility clustering, we can use the autocorrelation function of the squared returns. So here you can see we have high consistent autocorrelation if we plot that, and this shows the presence of volatility clustering. So this is this was the introduction lecture on the volatility models, where we have discussed why we need the separate type of models to deal with the volatility and why we are concerned with the volatility. Volatility is an important concept in finance because it has the certain implications which undermines the predictability of the which undermines the predictable features of the linear models. So in the next class, we'll discuss what types of volatility models we have and how we can implement those models. Thank you. See you in the next class.